people in that realm spending millions of dollars or one property in a year, they really like the ability to spend. And so being able to have a lot of deductions first year is very helpful for cash flow. The beauty of special depreciation is it can produce a loss. At least clients that I've dealt with a lot, having a tax loss for the year is important.
Thanks for joining us on another REI-NWA podcast. I'm your host, Coley Bailey. I'm a executive broker and team leader with the Lone Rock team at Fathom Realty. And today we're going to be talking about getting organized, getting ready for tax day, the dreaded day of the year. And with us today, I've got a special guest, a special treat. This is an accountant and an enrolled agent. His name is Brian Fleming. And Brian, thanks for joining us. Welcome to the show.
Thank you.
So you are here in Northwest Arkansas. Have you always lived here or where are you from?
Well, I'm from Missouri originally.
Okay.
Grew up on a farm near Nevada, Missouri. Until about 11 years ago now, I lived in the Joplin area and then came down here beginning in 2013.
Okay.
When I started really working here and living here.
Well, fantastic. So how did you become an accountant, and what's the difference between an accountant and an enrolled agent?
Okay, well, I'll start out with maybe just with the difference between an accountant and enrolled agent, just so don't forget to address that. An accountant is exactly what you commonly think of as an accountant, someone who works with finances, bookkeeping, tax preparation, that sort of thing. An enrolled agent is simply someone who has been authorized by the IRS to represent taxpayers. And so that is something that I obtained by taking the IRS exam, a battery of exams that they produce and offer to people who want to be enrolled agents who have the same rights with the IRS to represent taxpayers, on any number of things, to prepare tax returns, have the same representation rights as, say, CPAs or attorneys with the IRS. So it's just simply that. A lot of accountants prepare tax returns. A lot of CPAs prepare tax returns. A lot of attorneys prepare tax returns. CPAs have their own testing. Attorneys have their own testing. And then the IRS has testing for enrolled agents. So that is the primary difference, is that I've simply taken the IRS exam, several series of exams on a broad range of topics that enable me to be authorized by the IRS to represent taxpayers.
Okay.
Now, how I got in accounting was just kind of a roundabout way. I was sort of a lost child, so to speak. Came from a family that highly educated family, and but I was sort of kind of the black sheep of the family. About older brothers and sisters. I have one older brother who's a 4.0 graduate of Harvard Law School and PhD from Princeton, and I was didn't know what I wanted to do. Barely made it through high school. Always in trouble, and ended up basically mowing lawns for a living. I was mowing lawns for a number of years and operated a lawn and landscape business for around 20 years, but had this intellectual struggle. I needed something more. I found that I did well with my own books, my own tax. I've never paid anyone to do my own taxes. I just found that came easily. For one thing, that's what I started to think about. At some point in time, I decided I just had to have something different than I was driving myself crazy without a lot of engagement that I needed. And so I decided to pursue either being an attorney like my brother or something else. And the accounting came to be, and it just turned out that over a period of time of study and talking to people, attorneys, accountants that I knew, I chose that path. did well in the initial accounting courses when I went to college at a later time, non-traditional student, and did well. But I would say I kind of missed this point. I've always been somewhat of an entrepreneur, and I not only had the law business, I had several other small businesses that I established during that period of time. And so accounting and working in an accounting office was something that was appealing to me because it also allowed me to continue into self-employment, sort of being self-employed, helping people, providing, instead of providing services in their yard or home or that part of people's lives, I thought I'd be able to provide services in regard to finance and accounting and taxation.
Yeah. Well, and it's also probably helps your clients a lot if they are entrepreneurs, if they're running small businesses or real estate businesses, things like that you've been there, what they're going through, and also some of the pitfalls that they easily fall into as well.
Yeah, I've recently had a meeting with an investor. He's a real estate investor. He's an insurance agent. He has various things that he's been doing, and I had a meeting with him and a gal that has been working with him, and she just was saying he's just going on all these tangents. He's starting this business, he's starting that business, and it was like, yeah, that's me. I do that. I was doing that. And here, so yeah, I relate to these people that are entrepreneurs very well. Yeah. And I find myself very comfortable with them and definitely understand the drives, the things that drive them. And so I find it quite fun to work with entrepreneurs in particular.
Well, great. And so with the upcoming program, this is going to be a landlord lunch, and it is called Organizing for the Dreaded Tax Day. And we're going to get into that. I got some interesting points in here. One of those is that expenses may be different than costs. And that was kind of surprising. And so we're going to get into that right after this word from our sponsor. Are you struggling with real estate code compliance? Let Ordinal, your AI navigator, simplify it for you. Receive clear answers to your nuanced compliance questions in seconds with citations included. Currently, the Ordinal beta version specializes in the Northwest Arkansas cities of Bentonville, Fayetteville, Springdale, and Rogers. Join the beta version now and get your first month free using the promo code REI. After that, it's just $12 a month. Visit breakground.ai/Ordinal or click the link in the description below. Start incorporating AI into your real estate workflows today with Ordinal. All right, Brian. So let's talk about the difference between expenses and costs and why aren't they the same thing?
Okay. Well, simply, the two different things. An expense is something that is incurred on an annual basis, like insurance or electricity, utilities, other utilities, repairs, mileage, that sort of thing that you incur on an ongoing basis. You take the money out of your pocket to buy it, and then you use it. Cost, by cost, I mean things like real estate. So if you buy a house and it's going to be your rental, that is not an expense because it is not an annual thing. It's not something that's used up as you right when you acquire it or you use it over a short period of time. It's something that remains with you for a number of years and is only subject to the idea of expense through depreciation. So cost is the expense of that is the amount of depreciation that you deduct every year. So I bring that up because every year and not only every year, but even in daily accounting jobs or as working with a daily business, you run into this sort of thing and people don't understand. Even accountants don't understand a lot of this. Definitely the person that's not focused on accounting. Whenever someone comes in to have their they're getting ready for tax season, they bring in their books or their box of receipts, that sort of thing. very often you will find a receipt for, say, a house, in the box of receipts, and they want to deduct that all of the whole expense for this year. But in reality, that's not an expense; it's a cost, an asset that endures over a period of years. I just thought that'd be a fun distinction to make, because it just continues on and on and on. And someone goes out and buys they spend $50,000 on a truck, or, well, now I'm dating myself. Who pays $50,000 for a new vehicle nowadays? I mean, it's maybe $100,000. I've seen them up to $175,000. I've seen people pay $175,000 for a pickup truck.
Yeah,
and
wow.
They'll just throw that in there as, okay, we got to deduct this year. Well, not really. I mean, that's a cost. That's something that will endure for a number of years, and the cost is expensed over a period of years. And then in the end, that might be something that is sold and has value at the end of a period of time. And so that when sold, it becomes income to you in a sense, in the sense of it. Well, that's a little bit of a complex conversation on how that becomes income.
Well, then you get into capital gains, right?
Well, you get into gains, ordinary gains, and related to stuff like that's been depreciated.
Oh, okay.
Something like that. Yeah, capital gains is definitely a part of the equation when it comes to, say, a house, because the asset increases in value, and so you end up selling it for more than what you paid for it. And so in that sense, you do have capital gains come to play in a cost item. So I like to emphasize with the people, because it just comes up all the time.
So am I hearing
year.
this correctly, that costs can sort of become expense, or they can be expensed? So, like, for instance, real estate, if you buy a single family residence and you're going to rent it out, right, you can expense it over 27 and a half years.
Correct, yes.
So each individual year, you've got an expense for it, but the year that you buy it, it's a cost.
Yeah, the cost remains. So you pay $150,000 for a house, and you put it in, you set it up as an asset in your balance sheet or on your tax return depreciation schedule. And so that remains $150,000 for the entire time you have that asset. Okay. Except over 27 and a half years, you can deduct a percentage of that cost. And that in that sense, it becomes depreciation expense. Yeah. So that's the annual part of it. But in the case of something like a cost item like a house, at the end of the period, that still holds value. Then when you sell it, you end up having to pay back those, we call that depreciation recapture. You have to actually take back, as much of the depreciation as you've taken, you have to record back as income, as ordinary gain. And so in a sense of something that is normally an expense, well, it's long gone. You're not reselling your electricity, or even your repairs, a regular low cost repair, your pest control, anything like that. That's not something that's remained. That was an expense, an annual thing. So
okay, yeah.
So on a possibly thing as a roof, appliances, a remodel, an addition to a building, something like that. Those things are costs.
Okay. So, but things like, your insurance and your, just ongoing expenses, those are expenses.
Yeah, they're expenses. And the reason why I make this distinction is because I just kind of think, well, it'd be good to kind of help people kind of have this stuff separated beforehand. Because if you bring your stuff to me, then I'm going to have to come back, and let's say you put in your rental house that was, worth $150,000, and maybe, you have X dollars of rental income per year, say $10,000 or $15,000 of rental income per year, but then you've got something in here, $25,000 of repairs, and the repair is a expense. But I'm always going to know that, wow, that's a lot of repairs for this 1 year. I wonder what they did. So I'm going to ask questions, like, what did you do with this? How's this $25,000 divided up? And then they bring it out and they say, oh, well, we put a new roof on. Well, that roof is a cost, so I've got to pull that out and set that up as a item that increases your basis in the house, and also is a depreciation item that is expensed over a period of years. Or maybe part of the 25,000 was you put in all new appliances, you remodel, you put in cabinets and the countertops, that sort of thing. That's a cost.
Okay, that makes sense. All right, so let's talk about any recent tax changes that might affect landlords.
Okay. Well, the main thing I think in regard to real estate and landlords is the concept that we've had for a number of years called special depreciation. What that meant over the last few years, people have been able to, a investor, property owner, landlord, could incur a number of costs. Say, like they could, as I mentioned previously, they could put in a bunch new appliances into their house, into their rental property, or they could, put countertops in or something like that. That is something that has a life that we would normally depreciate over, 3, 5, 7, or 15 or 20 years. And so they would call those, 3, 5, 7, 15, 20-year property. So if something could be classified in the realm of 20-year property or less, while we set it up as a depreciated item, we didn't have to depreciate it over the real life of the property. We actually could just deduct 100% of it in the first year of purchase or construction or whatever. So that has been 100% for several years. And so a lot of people have taken advantage of that by buying at the end of the year. They look and they say, wow, we've had a pretty good year. But we do need to have a new tractor, or we need a new bulldozer or something like that. That would be a normally depreciable item over a number of years that we would normally only be able to deduct a certain percentage of that over the years. If we could deduct 100% of it, then that gives us a return. We have lower taxable income, so we save more taxes in the first year of purchase of that item because of special depreciation. And so with the recent the tax law, as recent as 2017, it's normally known as the Tax Cuts and Jobs Act, or the slang, in other words, the Trump tax code. That all phased out beginning in 2023. So in 2023, the change is no more 100% special depreciation. It's now, you can take 80% special depreciation, and then next year you can take 60% until they phase out the whole idea of special depreciation, unless Congress changed something. So that's an important thing, to not so much the average residential rental property, the person that has the houses and a couple $100,000 house and renting it out, but that's a lot bigger deal when more commercial like real estate, like warehousing or retail, those buildings that have much longer, those are 39-year. Some of the things that people in that realm spending millions of dollars on property or one property in a year, they really like that, the ability to spend, $100,000 on improvements on a property and then be able to deduct the whole amount in the first year because they've got a lot of cash tied up in it. And so being able to have a lot of deductions the first year is very helpful for cash flow.
Okay. Yeah.
So that's going to phase out. That's starting to phase out. And that's really the biggest deal that I'm aware of and really.
Yeah, that's pretty important. That's pretty important for people to know, especially if they're depending on getting that break, and then at the end of the year they're not. So
yeah, well, I mean, they're still going to get the 80%, or there's still Section 179 depreciation, which is another method that we are accustomed to. But the beauty of special depreciation is that it can produce a loss. At least clients that I've dealt with a lot, having a tax loss for the year is important. They are real estate professionals. Their main business is real estate, so they can have pretty big losses in a year, and that's very helpful because they probably have other things going on that they want to offset with those losses. I don't know that really applies that much to the mom and pop operation, but just to a lot of people, especially your people who are investing in, like I said, warehousing or retail space, things like that. It's a lot bigger deal.
Right. All right. Well, there's a lot that we can get into. I don't want to do the whole program here on the podcast, but the program is going to be coming up again. This is a landlord lunch. It's going to be on February 15th, 2024. It's going to be at the Wagon Wheel Cafe in Springdale. And once again, it's on organizing for the dreaded tax day. And come out and see Brian and ask him any questions that you might have along these lines. I'm sure it's going to be a really informative talk. That's always going to be, I think, doors open at 11:30, and then we're having a lunch there, so it's at noon. We'll start the program. All right, well, Brian, thanks for being on the podcast. Thanks for sharing those insights with us, and I can't wait to see you at the talk.
Thank you. Looking forward to seeing you.
All right, everybody. Thanks for joining us on this episode of REI-NWA, and we'll catch you on the next one.